Good morning. We're half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Asian stocks and currencies drop as President Trump announces what he calls permanent tariffs on foreign cars. Canadian and European officials are vowing to hit back.
Now, China gets hope for a potential reprieve, though, with Trump raising the possibility of lower tariffs if Beijing signs off on a deal on TikTok.
And an advisor to China's central bank tells us the government has the firepower to boost the economy after what he calls a, quote, reasonably good start to the year. We'll bring you that exclusive conversation from the Buyout Forum.
Welcome to the show. We have two full trading sessions remaining. Certainly lots of news still. Lots to come out of the Buyout Forum, of course, where the Vice Premier, I believe, is also set to speak. So just stay tuned for some conversations around that as well. Now, just in terms of the sort of the gauge of risk appetite at the current time, right? So that's the drop effectively when we did get that announcement coming out of Donald Trump, and news hit the wires of the 25% tariffs on autos, on top of everything else, of course, that we might get, of course, going into next week. We are, though, coming off lows of the day, as you can see on your screens. Now, certainly when you look at the euro, for example, it's come up quite a long way, right? So we're up right at about the 100-day moving average, right below that as well. And it does seem we don't have to talk about that as much today, as we do see this bounce, of course, to about the 107.50 handle. What we do have to talk about, though, is the weakness across equity markets, which, as you can see, is permeating on the benchmark across many markets that are up and running. One market that is coming online, of course, is Taiwan, 1.2% to the upside. Bond yields are also on the way up, so bonds are also hit today going into the open. Flip the page, please, and let's have a look at where we are as far as the approach to Chinese equities are concerned. We're in the thick of earnings season. There's a lot to get to. There's a lot of policy pronouncements to talk about as well. You know, China also came out with some measures to boost the sort of access and international hubness, if I could call it that, across the major cities, Shanghai, Beijing, Tianjin, among the likes. So we're looking at airlines, railway operators, infrastructure stocks on the back of that news as well. We're also looking at wind manufacturers today on the back of this one of the major players in the wind space, noticing a pickup in prices as well. So we'll see how that plays out across these markets. Jury's still out as far as that is concerned, and we're looking at the fix, of course, today closer than usual after we're roughly trading at about the lowest in about 3 or 4 weeks, highest on dollar China. 728 quite literally is the moving average right now. So we'll see what happens with this. Rebecca.
Yeah, I mean, the sort of underlying conversation to your point there, of course, is the tariffs and the news. We've been sort of wait and see mode for quite a few days here as we approach that April 2nd. But we do now have more developments. So President Trump signing an order just a few hours ago for a 25% tariff on auto imports, taking effect next Wednesday. Let's take a listen.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
So Bloomberg senior editor Derek Warbank joins us now, along with our China correspondent Min Min Lo. Derek, let's start with you. What do we know so far when it comes to autos and pharma?
Well, I think in the auto sector, there's a couple of key things that are worth noting, and one of those is that this doesn't just apply to automobiles as fully assembled. It also applies to auto parts as well. That was something that was being very closely watched. Now, the details of how this is going to work, particularly within the context of the North American supply chain, is something that still is a little bit in the works. There are a lot of parts that are shipped between the U.S. and Canada and the U.S. and Canada and Mexico and et cetera, back and forth in the production of some of these vehicles. And so how that's going to be treated is something to see going forward. But you only have to look at the aftermarket impacts to GM and Ford and Stellantis and et cetera to see, and then as well the Asian reaction to some of those car makers to see the effects on this. It's going to be pronounced. This is, look, Rebecca, this is a clear test run in terms of what April 2nd may look like, April 3rd in Asia, there is going to be an awful lot of action across a whole range of trade relationships, countries, products, etc. And look, we've been talking for a long time about whether people should take Donald Trump seriously or literally or whatever. I have long said he may not go as far as the most maximalist of threats, but he's not going to do nothing either. And this 25% tariff on autos for two of the U.S.'s closest trade partners is a really clear confirmation of that.
Derek, what have we heard from counterparts, like the Canadians, Mark Carney, and have we also heard from the Europeans on this?
Yeah, Ursula von der Leyen came out and had comments. Mark Carney came out and had comments. They are what you would expect, disappointed, etc. It remains to be seen exactly how there will be a counterpunch, if there will be a counterpunch from some of these places. Certainly the Canadians are working on options there. Doug Ford, the Premier of Ontario, was talking about that as well. I think that there was some question of what the U.S. would wind up doing if there were going to be loopholes, things like that. So we didn't necessarily, walking into this action, see a lot of countries say, here's exactly what we will do. It was something where they were going to see what the U.S. was going to do, and then they were going to respond. That's kind of where we are right now, awaiting the details of what those responses may be. But look, make no mistake, there is going to be a massive amount of complication. You know, David, you know well, I'm an adopted Michigander. I've lived, close to that bridge connecting Detroit and Michigan, and there's a whole lot of commerce that flows over that. People, who live in Windsor, Ontario, who work in Detroit, and vice versa. Those two economies are as connected as any two international places on the map, and this is going to be a major, major complication in that relationship that is very, very intertwined.
Derek, thanks. And the other sort of big part of the conversation that we haven't mentioned yet here is China, of course. And Min, it does look like potentially there may be some reprieve, that Donald Trump may offer some room for negotiation on tariffs, particularly to secure a deal.
Yes, I think we are all very excited and waiting with bated breath to see what the final tariffs would look like and what that deal could be, because Trump is saying he's willing to trade off those tariffs in exchange for getting Beijing support to sell TikTok. And remember, that deadline is April 5th, which is the end of next week. So we're counting down. Trump is saying he's confident he will be able to secure the outline of a deal, and if not, he will be able to get another extension. Previously, the TikTok was supposed to be divested in mid-January, and at the last minute, Trump managed to get this extension by 90 days. And Trump said he has been speaking with 4 potential bidders. He didn't name names, but we know that previously there had been groups of investors that had indicated their interest, including a group led by Frank McCourt, the billionaire, also another group involving Mr. Beast, that YouTuber. And Oracle could also throw its head into the ring. But look, this week you have Steve Daines in Beijing saying that no trade talk could really begin unless China commits to stopping the flow of fentanyl. Earlier today, you have Zhu Min, the former managing director of IMF, saying at the Boao Forum that China must be prepared for a trade war. So really hard to say how this negotiation will go. I guess we'll have to wait for next week.
Okay. As we, in many ways, have turned to TikTok for a reprieve here and an escape from the real world, I guess in many ways it really comes to fruition, doesn't it, in this story here. Min Lo and Derek Wallbank there, of course, on the latest here. For market reaction, let's bring in Mark Cranfield to just give us a sense of how we need to be thinking about this. Mark, I'm looking at the euro, obviously weak. We're coming off lows in that. Equity markets, though, are still feeling the pinch here. Does today seem one of those days, again, where it's going to be largely painful for risk assets?
Yes, it is to some extent, although I think, as Derek was saying here, there's a lot of confusion about this. And confusion, there's an old saying in the foreign exchange world, confusion breeds contempt. And the contempt in this case is going to be for the US dollar, because investors are going to see this as another reason why they shouldn't be invested in the world's major reserve currency. It's something that's been cracking at the edges for some time, and it's probably going to start to accelerate from here. So if you're an international investor and you've had a lot of money in the US, certainly last year, there was a lot of people were talking about the fact there was nowhere else to go. There was the US markets, you had to be in US equities, you had to be in the US dollar. That is breaking down quite quickly. Clearly, China is doing a lot on the AI-related space to make them look more investable. Europe is passing laws, which means they're going to increase their defense spending in other areas as well. Europe is also looking a better place to move money. The euro is the second biggest currency in the world. It's come down over the past few sessions, but it's probably at a point where people will start to think, yes, the euro is looking like a good alternative to the US dollar. So all of this, you put it all together, you're making a very complicated, messed up picture for US assets, so people will look for alternatives. The euro is certainly a currency that's going to benefit from this. And the beginning of the year, we saw the start of a dollar sell-off. It had a bit of a reprieve. It's probably going to get a second wind now. As we go into the April the 2nd, the day for all these extra tariffs to land, more and more people will be thinking, I need to switch into other currencies. And they'll be looking at places like the euro, probably the pound to some extent. Even the Canadian dollar will probably start to get a bit of a rebound. It hasn't been hit nearly as hard as people expected, even though Canada is such a big trading partner of the United States as well. So the rest of the G10 space can probably start to breathe a bit easier, and you'll see some flows moving in those directions. It's also going to be negative for US equities as well. Again, people will be looking for alternative places where the story is clearer and they can put their money into a more secure setting. So all of this, all of the head spinning, the knee-jerk reactions are all leading in the end to money moving out of the United States.
Yeah, that's a really interesting point, Mark. I mean, and Dave and I have been at the HSBC Global Investment Conference over the last couple of days, and the thing we keep hearing is this idea of wait and see until April 2nd. But it sounds like what you're saying is that even once we get that clarity, actually, we're still going to see a move away because of the complexity for trading US assets. So I guess my question is, what does it take to bring clarity to the US markets? And how long after April 2nd might we see some of those flows returning? Might we see investors somehow feeling confident enough to return?
Bringing clarity back to US assets probably means reversing all of the things that President Trump has been doing since he came into office. Well, that appears to be pretty unlikely. He seems to have set in motion a global trade war. It might be a big trade war or a small trade war. There might be adjustments to what's going on. Nothing that we've heard recently suggests that tariffs are going to be removed completely, or that he's going to be stopping to look for places where he can impose more restrictions on people. As long as they keep to that narrative, global investors will say, that's damaging to the United States, we need to go somewhere else. It looks as though we're on a slippery path here. It's not going to be a straight line. There'll be retracements along the way. There'll be good days and there'll be bad days. But what has been set in motion here is that people will see the United States as being a less investable place to go into. It's no longer, you have to be in America. There are alternatives. And we're beginning to see it happen already. Look at the US bond market as well. You would think by now that all the talk about wanting to get US yields lower, you would expect 10-year Treasury yields to be below 4% already. They're not. The curve is steepening. People are taking it out in terms of they're putting a premium on long-term US bonds. They want to earn a higher interest rate for keeping into long-term US securities, even though the Federal Reserve is supposed to be cutting interest rates 2 more times this year. That is not enough for people to be satisfied that US bonds are the right place to be. That is a big statement in itself, and that's also negative for the US dollar. This whole story is about US exceptionalism breaking down, either slowly or quickly. We'll have to wait out and see how fast it plays out. But that is the theme for this year. People will be looking for alternatives, and the US dollar is the first place. It's where macro traders go. If they want to express their views on the macro world, they start with a currency and then they work into other assets.
Might that other place, and I think it's an obvious question given the name of the show, might it be China? And might the reprieve or the potential reprieve because of TikTok provide that excuse, Mark, for buyers to come in and buy this dip?
I'm not sure it's got much to do with TikTok, but Bloomberg is running stories that say clearly people are getting more optimistic on the whole China story. Money is clearly being excited by the fact that China has a variety of AI products. It's not just DeepSeek. You've heard the other major companies, people like Alibaba, Baidu, others. They've all got their own versions of good AI products that can be done at a cheaper cost and are very Chinese-centric. That's exciting foreign investors, and it's clear that money is going back into the space. The PBOC is doing a good job of stabilizing the currency. Foreign investors can see that the yuan is being carefully managed. They don't need to worry too much on that score. Now it's just a question of, can the Chinese authorities do more to boost consumer sentiment, to get the economy moving in the right direction? Clearly, the AI story is very, very positive. It needs a few more things to fall into place. But certainly, the idea that China is uninvestable, that's gone. People are now just looking what is the right level to get involved in Chinese assets.
Okay, Mark, thank you so much. Mark Cranfield there in Singapore for us. Now we're counting down to the open of trade, just under 15 minutes away to the opening bell here in Hong Kong, in Shanghai, and in Shenzhen. And as Mark was pointing out there, the PBOC has done a good job at anchoring the currency. And to that very point, almost bang on a second here, another uneventful fix at about that level. There we go. Lots more coming up, including a conversation with the CEO of CanSino Biologics. They've reported some earnings, so we'll get a sense of the product pipeline ahead, and the open, of course, just under 14 minutes away. Good morning, Hong Kong. Welcome back. You're watching The China Show. An advisor to the PBOC says that the economy has actually gotten off to a good start this year. But authorities are prepared to deploy more stimulus if growth comes in lower than expected. Huang Yiping spoke exclusively with Stephen Engel, Chief North Asia Correspondent at the BOA Forum.
The government has made it very clear that if there is a need, both the fiscal policy and the monetary policy can step up. That, I think, is very clear. So basically, it will be data-driven. If the economy is strong, then perhaps we can just go with it. But if the economy shows signs of softness, then both the fiscal and the monetary policy still have enough scope for further expansion.
How would you assess it right now, coming out of the National People's Congress? There seemed to be a lot of talking about green shoots of confidence, but the property market in the first couple of months was still quite weak. Consumer demand still quite weak. And they didn't necessarily announce specifics on easing or further large fiscal outlays other than long-term bonds and the like. Yeah. Do you see right now the need for further easing?
Well, I think that we need policies to be ready if we need. As I said, it's a data-driven decision. But what we saw was after the end of September last year, the policies turned around and the numbers picked up. So the fourth quarter was much better than the third quarter. If you look at the high-frequency data for the first couple of months, I think we actually had a reasonably good start. Obviously, we needed to prevent replay of what happened before, that is the second quarter and the third quarter weaken again. And on that, I think the readiness of the fiscal and the monetary policy to support the economy would be very useful.
In the first Trump trade war, we saw, I don't want to use the term weaponization of the yuan, but we did see the weakening of the yuan, some 11% over 2 years. This time, the PBOC has kept it very steady and stable. Is that sort of weakening the overall easing buffet that is at their stable? Should they weaken it further?
Well, there are many different arguments. If you weaken the currency, that might be useful in the short term for exports. But at the same time, as you know, exchange rate also has a big impact on the capital flows. It has an impact on trade flows, but also on capital flows. I think for the policymakers, you have to balance, trying to weigh which is more important. If the currency is weaker, and hopefully, if it gets lots of exports, then it's good. But it's possible that you might not get a lot of exports while you weaken the confidence on investors. So I think, in my view, is that, our exchange rate is still managed float. So management is still part of it. At the end of the day, you need to balance the likely impact on different parts of the economy.
What do you think the policy response so far to the external shocks? Has it been successful enough? We don't know what's coming on April 2nd. There could be further tariffs. Is China going to be able to weather this external shock?
Well, China will be able to weather the external shock. The question is how big will be the shock. But that's also in line with the policy direction going forward. Exports will be important, continuously to be important. The question is, can China continuously rely on exports to drive Chinese growth? That's why the priority actually now is more on expanding domestic demand, particularly domestic consumption.
That's PBOC advisor Huang Yiping speaking exclusively with our chief North Asia correspondent Stephen Engel there.
Right. 16% is the move we're seeing right now. Stock that we knew was going to pop quite a bit today. This tender offer, well, I think it's a take-private offer from its biggest shareholder for the part that shareholder does not already own. 16% of the upside. We're looking at about $80 if you sort of do the math between the offer in cash and about the offer in stock. 16%, and of course the difference might just indicate maybe just the uncertainty that goes through. In any case, of course, more ahead, including this, plus a big earnings day. Hang Seng Index is called. Last we checked, slightly to the upside, but that's also being extremely generous on mine, 23,000. There we go. Plenty more ahead. This is Bloomberg.
Good morning. You're watching The China Show. Now, a stock to watch, and really we've been watching it for the last couple of weeks. CK Hutchinson, very much in focus. The latest now, a South China Morning Post report saying that sources are saying that Hutchinson and the government both are seeking a, quote, reasonable way out as the Panama deal deadlines. Worth just putting a little bit more context, Bloomberg also had its own scoop that suggested something slightly contradictory, that the deal is in fact moving forward and they're aiming to sign on April 2.
Yeah, I mean, there we go. It's an added complication here to the viable outcomes here, what comes out of this deal. That takes us into what else to watch today. So we talked about some of the technicals around the currency right now to the upside. It's about 728.01. We probably don't have to talk about a correction today. We'll see, of course, but we are a bad day away from a technical correction to the Hang Seng Tech Index. The Vice Premier is set to speak at the BOA Forum, plus a ton of earnings are coming through, and a moderate amount of economic data. The Open is next. This is The China Show. Good morning.
And welcome back. You're watching The China Show. We are counting down to the open of markets here in Hong Kong, Shenzhen and Shanghai. We were wondering whether or not there might be some kind of technical correction. Doesn't necessarily look like that's on the cards, at least for today. And of course, on the Hang Seng, we did see a little bit of a movement upwards as we closed yesterday. Yeah,
you had a couple of big moves yesterday, but are likely going to continue today. I think, as Mark Cranfield pointed out earlier. So apart from the macro, which is cloudy for most, maybe to a lesser extent in China because of the potential reprieve, there's idiosyncratic good news in the market, right? Alibaba releasing, again, it's a new day, yet another model here, AI model that looks at video and audio, for example. So that's one piece of good news. You are getting some commentary around some of the sectors where you did get some margin pressure. I'm talking about wind, and we'll look at that stock in a moment here, because the chairman actually yesterday commented that they are starting to see a recovery in prices and some guidance on margins. And plus, you have these measures coming through out of authorities to boost major cities as international consumer hubs, everything from airport access, payment systems, and being able to just simply link the world to the likes of Shanghai, Beijing, Tianjin, Guangzhou, if not already, really. Flip the page, please, and have a look at Hong Kong, where, as Rebecca was pointing out, we are still, to some extent, on industrial profits are coming out. We'll get to it later. But yes, on technical correction watch, it's not going to happen today. Well, at least in the early goings. I'm likely going to be proven wrong, but hopefully not. We are looking at a couple of moves on the big tech names, up about 0.8%. Yeah, that's not a lot. That's a bit boring. Okay, change the page. Thank you so much. There we go. That's the stock we're tracking. Mingyang Smart Energy, where the chairman does see a recovery there in prices of wind turbines. Xpeng, Rebecca can tell you about this a bit later on, but effectively they're looking at maybe increasing capacity. Elsewhere in the world, we talked about some of the access points, Beijing Capital, China Southern. Speaking of airlines, Air China is reporting earnings today. CNOOC, I believe, is also coming through as well, higher, and you have a really good representation here of consumer-facing names. Again, to be completely frank, not a lot here. It's a bit of a boring day. Maybe industrial profits numbers are more exciting.
Well, I don't know if they're going to be truly more exciting, but just as you were saying to your point earlier, they now have crossed the desk. So January, February, industrial profits coming in, falling at 0.3% year over year, but still a little bit of stabilization there. The thing we're really watching for is, are we finally starting to see stimulus support actually showing up in the data, actually showing up in some of these large companies' profits?
Big question. Yeah, maybe a little bit, but not completely out of the woods, certainly on that story. Now, we talked about earnings, right? So we talked about earnings here and to what extent we might be getting, of course, some support there. We are in the thick of earnings today. In fact, in Hong Kong, at least, we have at least 20 companies reporting today. One company that has reported recently is CanSino, China pharmaceutical company here. Net loss, nearly 380 million renminbi last year. That's down about 74% from the previous year. Let's bring in Dr. Xuefeng Yu, co-founder and CEO and chair of CanSino Biologics. Dr. Yu, as always, a pleasure to have you on the show, and thank you for taking the time. You're joining us today out of Brazil, I believe. What are you doing in Brazil?
Yes. Well, I come here to attend a global immunology and vaccinology research forum. This is a global expert gathered in Brazil to discuss the advanced technologies of vaccinology and immunology, and dealing with the potential global threat and the current issues of vaccination. This meeting is organized by WHO and the Bill and Melinda Gates Foundation.
Yes, and in fact, I was actually planning to ask you about that partnership and some of the amount of money that you got there from the Gates in a moment. But before we get to that, can I talk about your earnings specifically? Net loss, should investors be worried?
I think if we look at the trending, I mean, last year is a very challenging year for all the vaccine, industry. However, we actually have seen the significant growth in our, vaccine market in terms of earnings. Yes, we do have a lot of investment because of our rich pipelines on the R&D side. We still experience a bit loss, but I think it will actually pave the way for future to bring more new products to the market. And I think we're expecting to see we have profitable years coming. I think this is from the long-term perspective. I think I'm quite optimistic.
Dr. Yu, we also have seen this intensified competition among domestic vaccine producers and firms in China, increased R&D spending in that area. How does CanSino sort of intend to distinguish itself from its competitors, and how is it standing out in this field?
Well, I do agree with you. There are some hot products or vaccine potential products a lot of companies working on. But if you look at our pipeline, we are in the long term, we always focus on a few key products that align with our expertise and our platform technologies. If you look at the overall, we have our meningitis franchise, pneumo franchise, or pediatric combo franchise. Those actually will not be very crowded if I look at the competitors or our colleagues in the vaccine industry. I know for some of these vaccines, for HPV or the shingles, I do see multiple companies working on those. But I think we do have a unique position to strengthen our competition and also position our product to the market.
And Dr. Yu, I think just to build on what Rebecca was just asking there on how you plan to deal with competition, can I also ask you about your plans outside China, where may or may not be the case, competition maybe takes on a different form. What are your tangible plans to make inroads overseas, Southeast Asia, Middle East, and other markets?
Yes, that's a very good question. I think when we see the global vaccine market, there are countries still a lack of supplies. There are countries really have no vaccine manufacturer expertise or capacities. So we carefully analyzing the overall market situation. We actually clearly position where we should go, where we can contribute. As you just point out, I think like Southeast Asia, Middle East, and Latin America, those are the countries, they have significant amount of population. However, they really don't have a good handle on to get a vaccine supply. That is where we focus on currently, and we certainly have seen the progress, and we have seen some products already registered, and many of these products and in those countries are in the process of get licensed.
Can you tell us any more detail about what those licensing plans might be? And in those countries, for example, what vaccines are you specifically looking at? I'm also wondering if you're still allocating resources to pandemic preparedness as well.
Okay, so I'll give you a particular example. For example, Indonesia is a country with 300 million people. And certainly, there are still a need for the high-quality vaccines. We work closely with our Indonesia partners, so we have already licensed our meningococcal quadrivalent vaccine in Indonesia, and we're working on the tuberculosis vaccine with them and initiating clinical trials in the country. And we also conducting clinical trials for our VLP-based polio vaccine. So, and we certainly can see more products will coming to this country and actually will shape up this immunization, landscape. I think that's something that could apply to many countries, like in the Middle East, like in Latin America. I'm here in Brazil, also meeting with my strategic partners, Institute of Butantan. They are state-owned vaccine manufacturer, but we do have a lot of complementary needs, and we certainly can work together and really make each other available for a new product. So we are working. I mean, different countries will have different models, but overall, I think we all benefit from this collaboration.
And speaking of collaboration, we mentioned this at the start of the interview, Dr. Yu. The partnership with the Bill and Melinda Gates Foundation. I understand sometime late last year that you received some resources from the foundation as it pertains, I believe, to polio. Can you just get us up to speed of where the project is and what you hope to achieve there?
Yeah, the VLP polio project actually moving along quite well. I think we all know we want to eradicate polio from the world. However, we still have challenges with the wild polio still exists in near Pakistan and Afghanistan border area. Beyond that, we also have experience in broader regions of vaccine-derived polio. That means if we're continuing to use live attenuated polio vaccine, that there has a risk that the polio live virus will release to environment and causing disease. And if we want to completely eradicating polio, the VLP polio, which doesn't really rely on the live virus to produce this vaccine, is the way to go. This has been clearly indicated in WHO position paper. That's why the Bill and Melinda Gates Foundation really supporting us, very keen to supporting us to move this project along. Up to now, we have started the phase 1/2 clinical trials in Indonesia in the target population. And we have worked out the process and the manufacturer plan. That project is moving along quite well. And I'm very confident by the next few years, we can work out the details when we get the clinical results, and we will have our manufacturing facility available. And that was eventually we can supply the world for this new version of polio. And that will certainly allow us to, I guess, move to the final target to eradicating polio from this world.
Yeah, it's 2025, and I can't believe we're still talking about this, but to your point, please do everything you can to just take it to polio. Thank you so much for the time. Dr. Yu there, Xuefeng Yu, co-founder and CEO and chairman of CanSino Biologics there. A big mover to the downside right now that we're looking at about 12 minutes into the session here. Evergrande NEV, this is after Guangzhou Auto clarified the engagement or the lack of it. The company is saying that it and its smart car venture with Huawei have never engaged in any form of discussions with Evergrande NEV. Hence, stock is down. Clarify, absolute basis, it's a penny stock, so you do get an exacerbated move, of course, as far as this one is concerned. Plenty more ahead on the China Show. Right, welcome back. And how quickly things have changed. So on the Hang Seng Tech Index specifically, and we have been on correction watch the last couple of days. It didn't seem we were going to get there, but it's probably a conversation we need to have at this point in time at about 1.2% to the downside. So that now puts us two things. That now puts us below the previous low a couple of days back. Give or take, we're now down about 9.8%. So a move here and a move there would actually take this below that 10% handle. Of course, technical correction would mean we need to close below that specific level. So that is a couple of points just below the 5,500 level here on the Hang Seng Tech Index.
Thanks, Dave. Yeah. Well, the backdrop, of course, for today at least, maybe not necessarily for that index, but more broadly is, of course, the tariffs that we've seen coming in on autos, pharma, and so on. We spoke with Chinese EV maker Xpeng very recently. It says it's planning to ramp up its global expansion as rival BYD charges ahead, as well as, of course, in the emphasis on localization that we've seen from these kind of Chinese autos. I spoke with Vice Chairman and Co-President Brian Gu about their plans, including where they're looking to invest in factories and other infrastructure.
Our focus has been Europe, Southeast Asia, and now growingly in Middle East as well. For us, I think the globalization is not just making cars available for these markets to sell, but we see actually, it requires much stronger, commitment and investment locally. That's why we're actually building infrastructures. For example, we are now in process of building our R&D centers in Europe, in the German region. We're also looking at, as you mentioned, local production plans. For example, we recently announced a plan to jointly look at local production in Indonesia. And also, in terms of charging, we also actually are starting to think about local charging investments as well. So all of that, I think, is required to really build a robust global business. We actually have already entered over 30 countries in the world, and we have plans to enter dozens more. And I think with local investment, local focus, and local capabilities with the teams on the ground, I think that will give us a better chance of success.
Are there any markets where you're not yet producing cars where you're thinking that a localization push might be worth? I mean, in other words, what is the next market that you're potentially eyeing for that production, shifting production?
As we look at long term, I think if you have an aspiration to be one of the leaders in core local markets, you have to be local. And that's why I think for all the core markets, we think, whether there is a need for localization, I think ultimately we need to do it. For example, in Southeast Asia, as mentioned, Indonesia, maybe in other countries as well. Maybe in Europe, there's one of the large regions for EV sales. Maybe local plans and infrastructure is also required. Even in Latin America, some of the large markets require local investments. I think all of that, are things that we're monitoring closely.
Any Latin American markets where you see particular opportunities? Obviously, a really enormous market.
Well, countries like Brazil and Mexico are very big. In fact, I see also very good reception to Chinese EV products locally. So I think those are definitely core markets we're going to spend time focusing on.
Yeah, that's Brian Gu there, the vice chair and co-president of Xpeng, just discussing, of course, the business itself. And, he also talked about, I'm sure you did the interview, the conversation, it's worth pointing out that you had the conversation before the announcements this morning, right? But nonetheless, it was still a feature, of course, of all our conversations, really, at the HSBC conference, where it was the outside of external sort of shock events like the GFC or the pandemic, the level of uncertainty these days is comparable to any period, really, in recent memory.
Yeah. And I think for autos, yes, it was before the latest announcement on Trump. But
25, yeah.
When we asked him, he was pretty sanguine about those risks. And I think that key line there, you have to be local. This is now well beyond just an issue of dealing with US tariffs, but really a global approach to how you're producing. When you're producing one of these sort of sensitive sectors that has found itself so at the heart of tariff questions.
Yeah. In fact, let's listen in, because we had two conversations yesterday specifically on this, right? So this part really that Rebecca was just pointing out, Brian Good talking about how this specific bit on, it's not maybe an issue. We also had a conversation with the person who actually negotiated China's entry into the WTO on the U.S. side of things. And certainly we asked the ambassador, and we'll show you that in a moment here, whether, for one, the entry to the WTO was a mistake. She said no, but things sort of spiraled downward from there. And what really the antidote is right now, if it's not tariffs. Have a listen to those two things.
All the potential tariff, all the potential issues relating to doing business globally, it's par for the course. Because as a global company, you have to be ready to face all these different challenges. Maybe it's US you need to deal with, maybe Europe, but sometimes even in Asia, Middle East, every day there will be issues.
These general tariffs have little on the plus side. If we look at the first Trump administration, tariffs on steel and aluminum meant for the steel industry reduced productivity, because protected industries usually lose productivity. For the United States, lost jobs to the tune of 186,000, because the number of downstream users of aluminum and steel in the steel industry, for example, is 80 times greater than in the steel producing sector. And so the United States economy loses wealth because of that policy. That's what we're potentially in store for in the next go-round.
These two sort of different interviews that we did speak very, very nicely to each other, because of the point that the ambassador is making, is that essentially trade gets through. Global companies figure it out, and they figure out a way to continue to compete, to continue to be in that global market, although there's no doubt that these trade barriers are, of course, a challenge. And in a way, that point is spoken to so eloquently by Dr. Gu, saying, yeah, essentially, we're going to figure it out. We're going to work it out.
Yeah, we're going to find places where capacity needs to be. We can worry about cost now, but of course cost won't be the only consideration, of course, as we try and figure stuff out. And, I think the other point that the ambassador was making as well is, eventually the U.S. will need to look inside and look at things that might make them more competitive, things like the fiscal deficit, for example, and all those other things. In fact, we'll play those two things out in greater length later on the China show. We'll see you on the other side of this break. Hi, welcome back. You're watching the China Show. So just a quick note on airlines here. So one is Air China's coming with earnings today, and point number two are some of these measures, at least the lack of market reaction to the measures announced yesterday of China's longer-term plan to effectively boost the way big cities operate within a sort of international consumption context. Everything from hubs, payment systems, making it easier effectively for people to get in and, well, consume effectively.
Yeah, I mean, we have had the likes of economist Stephen Roach sort of questioning whether or not the statements that we've had from Chinese authorities on consumption are just sort of branded taglines rather than really firm plans to implement. I think there's still a question mark. I mean, it does seem the shift is very focused when we look at the NPC and so on, but there is there is this sort of skepticism around.
Yeah, the 30-plus point plan, I believe, is at the center of that. And, you know, if you ask most economists, they will have a comment on that plan. Eventually, they get to the point where employment prospects need to improve.
Yeah, it's fundamentally about the implementation here. Right?
It's going to go to that as well. Yeah. Just to mention briefly, this report coming out of the FT, this is good news, by the way. Chinese regulators have opened a path now for the iPro revival in mainland China.
Good morning and welcome back. You're watching The China Show. We are looking at the HS Tech about half an hour into the session here. It looked like we were starting off with a touch of momentum. That's quickly corrected itself. The level to watch for the correction is 5494. Dave, you were right. I mean, I did not really have this on my bingo cards this week, I have to say. I was a bit sceptical that we get there, actually, in part because we have had quite a choppy week, higher, lower, through the trading this week.
Yeah, I think we're waiting for, a further catalyst, right? So we were thinking it could have been earnings. What we have seen mostly, and not in all cases, of course, was, a sell in the news for good earnings, like Tencent, for example, right? So that has largely gone away. I think we're waiting for April 2 and what that looks like, and who knows what else we could hear ahead of April 2. Of course, reciprocal tariffs, and of course this morning the additional of the 25%. In fact, just on that very note, right? So within the Asian equity complex, we are zeroed in on some of the car makers for very obvious reasons. You just look at any headline, you Google any headline, it's probably going to tell you why we're looking at this group. On top of that, just now, Elon Musk commenting on X, talking about Donald Trump's auto tariffs and talking about how the tariff impact on Tesla is still significant. It's important to note that Tesla is not unscathed. You can check out, of course, his post for a fuller understanding of that, but suffice to say he's basically stating what the market had already known. In fact, Tesla's down 50% on top of the other things, of course, that are impacting and making a risk premium on that stock itself. Speaking of tariffs, it's also playing out across the FX space to a lesser extent now than it was, I would say, about an hour and a half back, although still some broad weakness across most, not all. It's worth noting the dollar Korea, of course, is still extremely near the highs of last year. Dollar Taiwan, dollar Indonesia, which has been hitting lows and lows and lows and lows of late. That's the weakest level effectively there for the Indonesian rupiah, going back to the Asian financial crisis, which I can't believe is now almost 18 years ago. Sorry, I'm doing math wrong. No, it's more than that. It's now moving on 28 years. Okay, so I'm skipping a century here. The outlook for and the state of markets, 0.4 of 1%. We were down as much as half of 1%. Indonesia, speaking of, is coming online right now. It's quite a topsy-turvy ride it's had these last 4 weeks. In fact, I think the 10-day actual vol on this index is actually back to the highest since when Rona first hit in 2020. Apart from that, it's broadly a session of risk aversion, although going into the European and Middle East sessions, it's worth pointing out that the euro's catching a slight bit off the bottom, so that might carry a bit of momentum going into that as well. But yeah, we're still focusing on the White House.
Yeah, I mean, to your point, it's sort of a tariff stay, really, for much of markets. President Trump signing a proclamation to implement a 25% tariff on auto imports beginning next Wednesday. Bloomberg senior editor Bill Ferry is with us now for more. I mean, Bill, let's just kick off with tariffs. What's the very latest? What do we know so far? And also, we do have a bit of reaction now from Elon Musk himself.
Yeah, so Donald Trump has been talking about April 2nd being what he calls Liberation Day for the U.S. economy, the day a whole suite of import tariffs come into effect. Adding to those now are these new 25% tariffs on imported automobiles. He says that cars imported under the U.S., Mexico, Canada trade agreement can be exempt from those depending on the makeup, how much of the parts and materials of those cars are made in America. But a huge change in U.S. tariff policy. It's going to have a big impact, particularly on Japanese and European automakers. We're already seeing that in the market today. Elon Musk, as you mentioned, coming out and saying that his company will not be unscathed by this, but most, if not all, U.S.-sold Teslas are made in the United States, so presumably those will be exempt. I think Tesla has some broader problems well beyond the new tariff announcement from President Trump.
Well, let's talk about the China angle here, Bill, because the TikTok element to the negotiation has come up again, and the U.S. president does seem, again, fairly open to maybe taking down some of the tariffs on China if it were to get on board on TikTok. What exactly do we know about that?
Yeah, President Trump, prompted by a reporter, made some vague comments about how he might be able to lower some tariffs on China if they reach a deal to sell TikTok to an American buyer. He said, you know, every percentage point you lower tariffs on China is worth a lot more money than all of TikTok is worth. It was kind of an aside of it in a comment to a reporter's question. So we don't have a lot of details on that, but it does suggest he's still looking for some kind of a deal that would result in an American partnership being able to buy TikTok. It's still not very clear that China wants to sell it, and I think China would want more than a vague promise of tariff reduction before it goes forward with any proposal.
I will just note this morning, in fact, the tariff discussion, Trump's tariffs, are trending on Chinese social media, one of the top topics on Weibo. And some of the comments that are coming through are really sort of somewhat sympathetic and critical for the U.S. Tackling some of its so-called little brothers here. Just tell us some of the reaction that we have seen from other countries that are really facing the biggest hits.
Well, Europe in particular has pushed back right away. They've said that they view this as a very unfortunate. Of course, it's going to hit big automakers like BMW, for instance, Volkswagen. Those companies export a lot of their cars to the United States. They have already promised retaliatory measures for many of the tariffs that Donald Trump has promised, because April 2nd is not just about the auto tariffs, of course. It's also about these reciprocal tariffs that he says will come into force fairly broadly. So there's still a lot of details. It does feel like every morning when we wake up here, there are changes to the U.S. tariff policy, and I think that's going to be the case going forward all the way until April 2nd.
Yeah, feels like I need to take the day off already tomorrow. And why don't we just let's
start the weekend early?
I mean, why not? And just circle back on April 2 and just figure out what happens that day. Team, thank you so much. Bill, I know you won't be taking the day off. Of course, we need you at the forefront of this. Bill Ferry's there, our senior editor, getting us up to speed here on, clearly, the hour-to-hour developments here on the tariff front. Now, what do we do with all this information? Changing information. Let's bring in Alexander Davey, Head of Client Portfolio Managers at Eastspring Investments. It's nice to see you.
Nice to see you as well. Thank you very much.
Been a while. I think the last time we spoke, we were at a different house, of course, 2023, if I'm not mistaken. The world is a very different place now. We have a different set of risks. How does that affect your world?
I think it's very much the case that coming into 2025, we were looking at the way that markets shaped up. Strong rallies in the US meant that there was a lot of impetus behind US markets. For our part, we could see that there were some challenges ahead. I think the three big things that we looked at, one was we expected uncertainty and volatility. That was a general call. I think people recognized that the changes in the White House would spur that. The second one that we really felt coming Q4 of 24 was that we would see a much bigger challenge to US exceptionalism. It's become more of a consensus judgment, I think, as we've gone into the first quarter of this year. I do feel that we're probably going to see the data and some of the elements around that more in the second half of the year, with that kind of slowing effect of data actually hitting and coming through. And the third thing for ourselves was around China. We were looking at China, and we felt that maybe there were opportunities and sectors that would do better, that being active and searching those out could be beneficial. And we had a big question mark as we entered the year around what the Chinese government response would be around the two sessions once we reached that. And really a number of commentators were suggesting that if there was a bit of a step up towards fiscal policy, that would be a very, very good thing for the Chinese economy.
A lot of meat on the bone there that you've given us. But I just want to pick up on that second theme that you mentioned, the fading US exceptionalist narrative, and that we're going to see in the second half of the year. Now, how do we position, or how are you positioning going into that, assuming that, you know, as many of the conversations that we had are about really the narrative in Asia becoming more attractive as an alternative?
Very much from the bottom up. For us, it's about the individual stock selection. If we look at the news that's out there, the tariffs, it's not about the broad base per se. That's what grabs the headlines. But if you're an individual company CEO, CFO, it's about what is the actual impact to the bottom line. If you're running across multiple places, what's the impact around FX? So for us, it really will be diving down into the minutiae with markets and look at and harnessing and thinking about the way that we continue to see an evolution of supply chains, and Asia continues to think about doing business within Asia as well as into Europe and the US. And there's been a big change since the initial Trump presidency, where there was perhaps more trade done with the US, and we've seen a number of initiatives, including RCEP and others, to broaden out that intra-regional trade. So very much bottom up and looking at how that impacts the stocks over time.
For income investors, what are the opportunities now?
Well, Asia's a fascinating place for income investors. It's always statistically been a place where shareholders have been rewarded by companies with a good proportion of income. A figure I think is around about 55, 57% of the total return coming out of stocks is driven by the proportion of income as well as the return, and that's been going up over time. So income is attractive within Asia because you're rewarded by the companies for investing with them. The secondary point is within a volatile market, income quite often acts as a bit of a buffer. It's providing you with some stability, it's providing you with return. Those companies are also a little bit more robust quite often. So we see that as an area that is attractive from an investing perspective generally, but certainly in a more aggressive and more volatile market, this could be a great place to be looking at positioning into.
And China, so you came in with a contrarian view that has now become somewhat consensus, of course helped by the fact that the MPC labelled consumption as its #1 priority for this year. I mean, with that assumption and with also the fact that it is still taking quite a long time to see that stimulus support coming through into the data itself, how are you thinking about investments? I guess not just for the next 6 months, but I'm really thinking sort of next year, the year after. Where are you sort of looking at potentially as new areas?
I think there's a couple of areas. There's a little bit in some of the industrial subsectors. We're starting to see a little bit more positivity than we'd seen previously. The impact of this focus on the consumer is we've seen the frenzy around AI, but actually what I think we start to begin to see is some of the if there is an increase in consumer demand, some of those e-commerce stocks could be real beneficiaries for that. And I often pivot back to the point that if you think about what drives the US market, it's very, very driven by the US consumer. And we know that in China, they've got the highest savings rates they've had in decades. If they can get a proportion of that, massive population, a proportion of that, with a rising middle class spending, that could be beneficial to a number of subsectors. We know that the tech sector is one of those, but e-commerce and a number of the domestic A shares. So keeping a very close eye on all of those elements and seeing how that stimulus impacts the ongoing consumer demand and hopefully gets some of those consumers spending some of those savings.
Can I ask you about India? Because it's come up a lot, given, of course, the pullback in the market, and people are arguing now if indeed the structural story remains robust. And I think you ask any economist, they're going to tell you, has value now emerged in that market? But if you ask retail investors, they're actually getting burned quite a bit right now with India. How are you thinking about India? How do we engage in India if that is an opportunity to get into?
Two really interesting points with India. Well, I think the first one is that there was a perception, rightly wrongly, that the government hadn't necessarily supported as fully as it could in 2024. And I think coming into 2025, that perception is going away. There is a degree of fiscal support. The government's been seen to be putting more capital to work. So that's one part. The second part is the central bank cutting rates. We're coming into February. We felt there would be a cut in February and probably 2 more during the year. We had that February cut. We can see further cuts coming down the line. Second half of the year, that looks supportive, I think, for the India market. So that second half narrative that we had coming in, certainly we feel is strong. Alongside that, we've seen a lot of foreign investment coming out of India. Perhaps you can argue a number of reasons, but Indian equities certainly had high valuations, even relative to their own historical valuations. Therefore, you've got that opportunity that investors may be more willing to come back to that India market, quite domestically focused. And at the same time, there is, I think, around about 4 billion of flow coming in through individual savings accounts every single month from the domestic Indian market. Yeah. So that creates a little bit of a floor in terms of you've got regular buying, but we're at a very, very low ebb for foreign investors. So I think the confluence of those two things, you've got a supportive government, supportive backdrop, some fiscal policy. Companies have come off a bit, so valuations feel, arguably a little bit more and of an entry point and sustainable. Some great companies there still, so you maybe start to see that foreign flow coming back in, more supportive, and you could well see, a stronger Indian equity market in the second half of the year going into 26.
Excellent. Alexander, thank you so much for joining us. I hope we don't leave it so long next time. That's Alexander Davey, Head of Client Portfolio Managers at Eastspring Investments. And still ahead on the China show, as President Trump ramps up his tariff war, a former senior US official tells us why China's trade surplus is too big for the world to accept. That exclusive conversation next, and plenty more. You're watching the China show. This is Bloomberg.
Welcome back. You're watching The China Show. So yesterday we had a really good conversation with the former U.S. Trade Representative and Ambassador Charlene Barshevsky. She effectively thinks that when you look at China, for example, it's running quite a massive trade surplus that the world actually cannot live with. So there needs to be some changes there. And she also put out some prescriptions really on how to deal with these global trade imbalances that we all know, of course, Donald Trump is trying to address in the U.S. side of things. So catch this conversation we had with her, exclusive one, of course, at the HSBC Global Investment Summit here in the city.
Was it a mistake? Absolutely not. When you consider that 500 million people were brought out of poverty in China because of that economic change, when you consider that China became an important import source for the world and indeed the demand driver during the global financial crisis, not a mistake when you consider China's contributions on the export side, provided demand signals were appropriately responded to, not as happening today. China has reverted to a highly statist economy, that China is non-responsive to demand signals, which is to say flooding the market with exports, and that China's basic development model, which moved from reform and opening to highly statist, is a model wholly dependent at this juncture on investment in manufacturing. Not what the world needs right now. We don't have a supply problem in the world. We have a demand problem. And in that regard, China's contribution to demand, which used to be a positive, is now a negative, which is to say a dearth of demand in China because of structural and other issues in China. So China is exploiting manufacturing, suppressing domestic consumption, and expects that the world can live with $1 trillion Chinese trade surplus, which most certainly the world cannot.
One of the major pivot points this year has been this focus back among Chinese policymakers on boosting domestic consumption. I can't think of a better way to solve trade imbalances by getting that entire market buying again. Well, do you think that should be part of the consideration in terms of negotiations? That there is this exercise, while long it might take, for example, to get demand going internally?
I think that's absolutely a critical focus, and in the minds of some, the critical focus. So China has provided various plans to stimulate consumption. They're generally vague, and they generally have fallen short. It just came out with a new 32-point plan on this. We'll have to see how that is implemented ultimately and what the actual detail is. I do think there is finally a realization in China on the part of the leadership that indeed driving consumption does become very important. It's an important part of the equation, and the imbalance that exists in China's economy today can't be rectified until consumption increases.
I can't think of an exporting economy that will do a sufficient enough job, apart from China, to satisfy trade imbalances. In other words, are we looking for an export market that the world actually does not know? Like, what do we need to be asking China to do? What is its part in solving trade imbalances?
More important than China in solving trade imbalances is the United States. So the focus on tariffs in the United States, for many reasons, is largely misplaced. What the U.S. needs to do is bring down its fiscal deficit. It needs to reorient supply chains, not by itself. It can't do it by itself, but by, in fact, engaging with allies, partners, many others, to try and bring manufacturing back to the U.S. and other countries.
That's former U.S. Trade Representative and Ambassador Charlene Barshevsky there. And in fact, just as we were listening to that, it's almost as if speaking directly to this, we did have some lines from the Brazilian President Lula saying that he thinks tariffs will be bad for the U.S., that they'll cause inflation. He's speaking in Tokyo, by the way. But yeah, I mean, really interesting. We're now starting to see more reaction from various countries hit by Trump's latest tariffs, and all of that reaction starting to trickle in. We'll get more on that and on some of the other big tariff stories as well. You're watching The China Show. This is Bloomberg. Good morning. You're watching The China Show. Here are some of the top corporate stories that we're following today. TD Cowen analysts say Microsoft has cancelled new data center projects in the US and Europe due to an oversupply of computers that power AI. They say the move reflects Microsoft's earlier decision to pass up some new business from OpenAI. In a statement, Microsoft says it remains well positioned to meet increased customer demand. CK Hutchinson and the Hong Kong government are reported to be discussing a way out of the company's deal to sell 2 Panama ports to a consortium led by BlackRock. The South China Morning Post quotes a government source saying they're looking for a, quote, reasonable way out. Bloomberg had earlier reported that senior Chinese leaders called for an investigation into whether the deal violated national security. One of China's biggest wind turbine manufacturers says industry efforts to boost prices are starting to bear fruit. The chairman of Mingyang Smart Energy Group told us prices have recovered since February, and there's potential for a further price rise of 5 percentage points. China's wind power industry has been affected by a price war, but manufacturers have signed a pact to curb competition.
Okay, now let's get some of the movement we're seeing across Asia-Pacific chip makers, and I think part of this was what Rebecca was just pointing out there, and the commentary coming through out of TD Cowen on Microsoft. The other part of this as well concerns this FT report that China's looking at new energy rules, or China's energy rules for advanced chips could actually dent demand for high-end chips from the likes of NVIDIA, for example. So it's playing out really on top of that. It's also a day where we are seeing broad risk aversion across risk assets and equity markets, specifically in the region. And of course, these are some of the names that you will initially get hit when you do have days like today. Plenty more ahead. This is Bloomberg.
Good morning, you're watching The China Show. Shifting now to Japan. It's 11:29 a.m. in Tokyo. Japanese markets about to go on a break, and it's not a particularly happy day. We are down nearly 1% when it comes to the Nikkei, and down about 0.4% for the Topix. Worth noting also that, in fact, actually Brazilian President Lula is in Tokyo today, talking about the need to strengthen Japanese-Brazil trade ties. But yeah, the tariff sort of discussion really everywhere that we shift.
Yeah, in fact, he made those comments, interesting enough, when we were talking about tariffs earlier, and I think he's talking about how it's not the right solution, it's inflationary, and I think to your point on building trade links with Japan, I think they were talking about beef trade links, if I'm not mistaken there. I'm not sure which beef is actually better, because Brazil does pretty good beef. I mean, so does Japan. So
Talking about two pretty heavy hitters there.
Yeah.
It's kind of getting me hungry. Well, and they're about to go to lunch.
Well, go for the protein fix. But before you do, a reminder that car makers are under pressure on again, here we go. All roads lead back to the tariff story. Toyota's down about 3.3 going into the close. We're down about 2.7% on the broader Topix autos benchmark. So yeah, we'll keep you guys updated on this. But yes, go and take a break there. Certainly much needed one. Right, across the region though, a couple of markets are still up and running, of course, suffice to say. We're broadly down in price. It just so happens that where you are getting some pressure is really where you get some of the heavier weightings. But on a sector split, it looks much better on this front. U.S. futures have also turned slightly positive, if not just a little bit above zero, which I guess is a good indication. Plus, the euro is also coming off lows of the day, so that is, I guess, in some ways, direction-wise, a good sign going into the open of the European and Middle Eastern session, of course, later on in a couple of hours from now. But yeah, let's stick with China, stick with earnings, and certainly a lot more to discuss. Yeah.
Talking about earnings. So one company that we are looking at now is Zhihu. It claims to be one of China's leading online community content platforms. So think China's equivalent of Quora, for example. The company reported its first profitable quarter in the 3 months of December, and it's investing in AI applications to improve its services. Han Wang is Zhihu's CFO and joins us now exclusively from Beijing. Thank you so much for joining us, and congratulations on those earnings. What are the numbers that really stuck out to you, apart from, of course, that top level number? And I guess more importantly, what's next?
Yeah, I mean, I think this is the first ever quarter that we have been profitable for the 14 years of this company. I think that's very exciting news for the whole company. Last year we were a company still losing $100 million every year. But this year, after I joined, in late Q1 last quarter, we have an internal discussion on strategies going forward. Actually, we made some quick adjustment very fast, and you can tell in the three quarters, step by step, we achieved profitability in such a short time. It's a little bit similar to what Elon has done on Twitter or X, but we didn't lay off 80% of people. But you can tell we earned $40 million to 11% net profit. But last year we were losing net loss was 15%. So it's huge, right? I think that's the most exciting thing, and it's proven to the market that actually we're a UGC platform with 60% margin. All the content is originated created by users. So I mean it's a great business model. I mean, this quarter will prove to the market that we're capable of being profitable in future.
So you didn't lay off people. I want to ask, are you hiring? What are you adding to your headcount?
Well, actually, we hired a lot of AI talent So I think it's a great talent. It's a great timing for us to develop AI. I think what we have done is very important. We were very in depth, like professional content in the internet before, but people are always challenging us, like, oh, your users are so smart, your content is so in depth. So while you will have less time span on your app than other entertainment short video platforms, right? So maybe your advertising will be challenging, but now the thing is totally different, right? So AI will always give the highest weight to the best, in-depth, most professional, the best content. So where is that? So that's all on Zhihu. So in that case, the AI area where it's different from the internet, it's if you have the best users, best quality data, you will be like way more important than before. So I think that's why we're so excited about this opportunity. We're hiring some new AI talents to build. We launched our new AI search engine. New AI search product is called AI Zhida, and its user is growing from 1 million to 10 million in just past several quarters.
Yeah, David here, and I'm glad you talk about AI because as a platform that is, I mean, let me borrow the way you guys describe yourselves, question and answer and providing quality information. I was hoping you could talk a little bit more about AI as, how you use AI as an opportunity, because I can see how it's also a risk to your company when people get their tools on other models, for example, that, they might not need as much time on your platform. But yeah, correct me if I'm wrong.
Well, yeah, people's always so what can help? Everybody is using AI, but everybody knows that you cannot trust AI 100% because there's hallucination problems, right? But how can you solve hallucination problems, right? So if it's not AGI in 5 years or 10 years, so you still need to believe in real world experts. So where is the real world experts? It's all on Zhihu. It's very interesting. You can see in China, there's no linking anymore, and all the other social platforms are very entertainment oriented, right? So we're the only go-to platform for those professional users with public professional profile. We're the only site with that. So if you wanna ask something on our search AI search tools, we will give you the source of every sentence. I will give you a source by, oh, this is said by which guy in our platform. What's his profile? Oh, you can see this is a professor from this university, or this is a director of this big company. You can trust them, right? So we are the only site with all these real experts. And well, if you're a big company with a lot of money, you can definitely develop another DeepSeek. You can develop ChatGPT. You can develop LLMs, right? But everybody can do a wrapper of ChatGPT or DeepSeek, but can you do a wrapper of a real expert network? So if people want to ask the questions, go ahead.
Sorry, just to jump in there. I mean, so if I sort of interpret that correctly, what you're saying is that the sort of user part of your database, in a way, is the secret sauce. It is the antidote to the so-called hallucinations of AI, essentially when AI gets things wrong. But the assumption, of course, that AI companies would say is that ultimately there will be no hallucinations, or at least they'll be very much more limited. So I'm wondering, in that universe, how do you stay competitive? What is the sort of longer-term plan 5 years out for your value proposition?
Well, actually, so if you think of the fundamentals, right? So if you're the AI is really smart, but if you and I, we still have a lot of thoughts, we have a lot of our knowledge, we didn't express that on the internet, right? If you don't write it down on the internet, how AI can learn about that? Right, so we are the destination, we're original places that people share their insights, and after that, AI can start to learn about that, right? And we can quote that source of content buy our platform because we know they're professional users, and every sentence they say, we can tell, oh, this is from these professional users, and you can chat with him more on this topic. You can browse what he said before and follow what he will say in future. So I think that's a more reliable way for people to research in a long time.
Okay, and I guess in what way are you looking to ensure the momentum continues, whether that's product innovation, AI within the product, and I guess in what way can you ensure that the profitability that you guys have managed to achieve, to your earlier point, continues?
Yeah, first, you mean the momentum, right? How do we keep that? More and more people are coming to us because very interesting thing is they are thinking about GEO instead of SEO. What GEO is? SEO, everybody knows as a search engine optimization, right? But people are more thinking about GEO, generative engine optimization. So if you ask AI, what's the best company? What is the best restaurant? You want to rank higher within that answers, right? How can you rank higher? So if you use all these ChatGPT products in China or around the world, so if you ask Chinese questions, they will always quote Zhihu's articles, Zhihu's content at the top weights or top rank. So that means if you want to rank higher within the AI answers, you would love to spend more time and writing more articles on Zhihu. I think that's a huge opportunity for us. A lot of people ask us, oh, how can we participate in your products? We're just getting started, and this source the content to a real expert. We just launched it a couple of days ago. I think we already started to gain very positive feedback on that. I think we're just getting started.
A final question for you. As CFO, I'm looking at your balance sheet. You're sitting on quite a bit of cash. Is that too much cash?
Well, we used to be a $5 billion, $7 billion company, right? In that case, where cash is not that much, right? So it's just this maybe geopolitical or the dynamic. We have so much discount and it's so cheap, right? So you can tell, right. You can tell even if we go back to our cash level, we still have 70-80% upside for investors, and we already break even from losing money for decades, right? It's if you look back 10 years before, and there's so many years, there's a company that's break even, so much cash, and used to be you can tell we're 80 million MAUs with network effects of the most well-educated users among China, and this with 60% more margin. This is model on US. Facebook has 50% net profits, and Twitter has gone to 40% net profits, and it's we don't need to pay for royalties to buy content. This great business model is proven business model, and we're so cheap. Yeah.
If we had more time, I would have asked you to name names and which companies are paying people the relatives to buy. Me asking you almost rhetorically if you had too much cash, Han Wang, was effectively me saying congratulations on the achievements that you laid out, and thank you for being so game. Let's do this again, sir. Again, CFO there of Zhihu, listed, of course, in the U.S. and, of course, here in Hong Kong. All right, some news coming out. KKR, and this is a deal in Japan. This is according to Reuters here. That KKR is nearing, so a deal has not been reached, but is nearing a deal to buy Topcon, which is, of course, a Japanese medical equipment or gear maker. That's according to, of course, sources out of Reuters there. Just to mention that as well. We are on the lunch break, of course, over in Tokyo. Plenty more ahead. This is Bloomberg.
Good morning. Welcome back to the China Show. Now, an advisor to the Chinese central bank says the economy has gotten off to a good start this year, but authorities are prepared to deploy more stimulus if growth loses momentum. Huang Yiping spoke exclusively with our chief North Asia correspondent Stephen Engel at the Buyout Forum. Let's take a listen.
The government has made it very clear that if there is a need, both the fiscal policy and the monetary policy can step up. That, I think, is very clear. So basically, it will be data-driven. If the economy is strong, then perhaps we can just go with it. But if the economy shows signs of softness, then both the fiscal and the monetary policy still have enough scope for further expansion.
How would you assess it right now coming out of the National People's Congress? There seemed to be a lot of talking about green shoots of confidence, but the property market in the first couple of months was still quite weak. Consumer demand still quite weak. And they didn't necessarily announce specifics on easing or further large fiscal outlays other than long-term bonds and the like. Do you see right now the need for further easing?
Well, I think that we need policies to be ready if we need. As I said, it's a data-driven decision. But what we saw was after the end of September last year, the policies turned around and the numbers picked up. So the fourth quarter was much better than the third quarter. If you look at the high-frequency data for the first couple of months, I think we actually had a reasonably good start. Obviously, we needed to prevent replay of what happened before, that is the second quarter and the third quarter weaken again. And on that, I think the readiness of the fiscal and the monetary policy to support the economy would be very useful.
In the first Trump trade war, we saw, I don't want to use the term weaponization of the yuan, but we did see the weakening of the yuan, some 11% over 2 years. This time, the PBOC has kept it very steady and stable. Is that sort of weakening the overall easing buffet that is at their stable? Should they weaken it further?
Well, there are many different arguments. If you weaken the currency, that might be useful in the short term for exports. But at the same time, as you know, exchange rate also has a big impact on the capital flows. It has an impact on trade flows, but also on capital flows. I think for the policymakers, you have to balance, trying to weigh which is more important. If the currency is weaker, and hopefully, if it gets lots of exports, then it's good. But it's possible that you might not get a lot of exports while you weaken the confidence on investors. So I think, in my view, is that, our exchange rate is still managed afloat. So management is still part of it. At the end of the day, you need to balance the likely impact on different parts of the economy.
What do you think the policy response so far to the external shocks? Has it been successful enough? We don't know what's coming on April 2nd. There could be further tariffs. Is China going to be able to weather this external shock?
Well, China will be able to weather the external shock. The question is how big will be the shock. But that's also in line with the policy direction going forward. Exports will be important, continuously to be important. The question is, can China continuously rely on exports to drive Chinese growth? That's why the priority actually now is more on expanding domestic demand, particularly domestic consumption.
There you go. That was Huang Yiping, PBOC advisor, with our Stephen Engel, of course, speaking exclusively at the forum. Just very quickly, so again, looks like it's not going to happen again today, but which is a good thing, by the way. Don't take my tone for it. The Hang Seng Tech Index has swung back into gains. In fact, we're now up session highs, 2.2 to the upside. At one point, we were 200 points below the current level at 54.99, and as you can see now, we're trading at 5700 as we speak. So this might have to do with this next stock that's coming up on your screens. We're checking shares of Alibaba as well. On the back of this news that a company has released a new AI model that says, well, the company says can process text, pictures, audio, video directly on mobile phones and also laptops. The shares are up, there we go, 2.7%. Let's bring in Min Lo, our China correspondent, for more details on this. And so what are the potential real-world uses of this one.
That's what investors are concerned about, whether these AI ventures will bring in the cash flow. So Alibaba is saying that this model can help to create an AI agent that could assist the visually impaired to make sense of their environment with these real-time audio description, because it has the capability to have very strong audio, speech understanding and speech generation. And this is a company that has been rolling out these new iterations of their models at record speed this year, and is investing not just heavily in AI infrastructure in the next 3 years. It's been wanting to partner with companies for these real-world applications to bring in that cash flow, right? So the latest deal they have is with BMW to create this AI cockpit to make this AI assistant in these cars that are produced in China in models that will be rolled out next year. And these assistants in the cars will be able to help plan your trips, help provide restaurant recommendations nearby and offer parking. And it's a win-win for BMW as well, which has been facing dwindling market share, its sales down 13% last year amid this intense competition from local rivals. And it's joining these other foreign brands that have been seeking these tech partnerships to upgrade their tech expertise in order to keep up with the competition, because these software has been the important component, the differentiator in the EV race in China.
Sounds like LiDAR for people. Although maybe I've got that totally wrong. But anyway, fascinating.
I guess so, Except that people don't have an internal airbag, though.
Whispering in your ear. Yeah, okay, fine.
Yes.
No, really interesting. So the other big news, we also have Tim Cook, Apple chief, of course, in Hangzhou, the center of AI innovation, really, in China.
Yes, so he was there. He visited Zhejiang University, which is an elite university that has churned out the likes of the DeepSeek CEO Liang Wenfeng and Pinduoduo's founder Colin Huang, and he hailed these so-called next generation of coders and developers. He was there because his company had donated 30 million yuan or $4 million to the university in a partnership to support this mobile app innovation competition to provide technical and business training for students. And I guess it's a bid for Apple to show its continued commitment to this important market, where it has seen iPhone shipments down about 25% in last quarter, again amid the competition from Xiaomi and Huawei. And it's a mutual engagement from both sides, because he was in Beijing for the China Development Forum, sat down with the Commerce Minister Wang Wentao, who said China welcomes these investments and the continued integration of Apple into the Chinese economy as well.
Thank you so much. Yeah, we'll keep an eye on that. Bloomberg's China correspondent Min Lo. There's plenty more ahead. You've been watching The China Show. This is Bloomberg.
Welcome back. Just before we wrap up the shows here, just to flag a couple of things. One is the market has certainly turned a corner today, opened slightly to the downside, hit a low, and then, as you can see, has reversed almost all the way up. We are at about session highs going into the last hour of the morning session here, Rebecca.
Yeah, and of course we are still, Buyout Forum is still going on. A really important backdrop, of course, it's happening at the same time as we're seeing all these developments on tariffs. Very, very interesting to watch the tone and tenor of conversations, particularly among former and current Chinese authorities.
Yeah, in fact, on that. So he will be making the opening, delivering the keynote speech at the opening ceremony of the Buyout Forum there in Hainan. That's the China's Vice Premier Ding Xuexiang. So pay attention to that. But for today, that's it from us here on The China Show. Dave and Bex, we'll see you tomorrow for last session, last show before the weekend.